Hi guys, and welcome to my channel. My name is Vlad. I'm a long-term value investor, started investing in 2016, and I have a page on etoro where I manage a small portfolio of assets for other people. Today in this video I would like to discuss and share my views about the current market valuation. As you know, the market representative market in general is represented by S&P 500 index. This is a benchmark which is usually wide used by various people to measure performance, invest, etc., etc. So now, today I would like to share my view about the current valuation of the S&P 500. As you know, there are a number of ETFs available on the market, and people are investing in this ETF. So basically, they are replicating the 500 US largest companies. Today, I would like to share with you this analysis. So just to give you an idea, this is not an investment advice, okay? So should not be considered as an investment advice. I am not a registered advisor in any way. However, as I said, I do manage a small portfolio of assets. So I'm just sharing my views in this video. Okay, so let's start. S&P 500. A number of ETFs are available on the market, and you can easily go and find them on Yahoo. So one of them is SPY. This is the most popular, I believe. However, before investing into this ETF, I would like you just to consider these points, guys, because look at price earnings of this index. When we look into this multiple, the price earnings currently stands at 27. So in my view, this is very huge, and this means that a basket of shares which you are paying for when you are buying an ETF is very expensive in my view. Okay, so inverse ratio, this means that your earnings yield will be less than 5, right? When you inverse and you divide earnings by the price, it will be less than 4, actually, less than 4%, guys, annually. So think about it. When you buy an ETF, you will eventually you are going to have not more than 4%. Okay, obviously this is subject to price earnings being uh, stable and equal to this amount, basically. So considering that there is no further increases in price earnings ratio. So in my view, currently this valuation of S&P 500 is very expensive, and that's the reason why I basically don't invest in S&P 500. Why I believe it's expensive? Okay, guys, let's have a look at Schiller's price earnings ratio. You know, there is this ratio which was implemented a number of years ago. So basically, in this ratio takes into account average earnings of the last 10 years. It doesn't take into account just 1 year, but average of the last 10 years. Like this, you will have a more representation, and like this, your price earning ratio is sort of more stable, right? So, and more reasonable to look at. So what does it says to us at the moment? Using this ratio, implied market return for S&P 500 is less than 3%. So based on this ratio, okay, based on this ratio, if you invest in ETF, you will get 3%, less than 3%, long term. So usually this ratio applies into the future. So during the next 8 years, you will get a little bit less than 3%. Okay. So that's one of the reasons, and I really like this indicator. I don't know what you guys think about this indicator. Maybe you already know something about this, so feel free to leave your ideas in the comments section. But 3% is basically, for me at this level, it doesn't make sense to invest in stock market because look, with if you just go to buy a bonds, US government bonds will deliver you more return, because if you look into US Treasury yield curve at the moment, and you can just go into US government bonds and invest in 1 year or 2 years or 10 years. There are obviously some implications about the Shiller price earnings ratio. Okay, so let's have a look. I would like to share these guys with you, because here you can see that what does it say, and you can challenge me obviously, because okay, you might say how what is the prediction power of this Shiller price earnings which you are talking about, and that will be a reasonable question. uh, in my opinion, and when I look into this graph, all right, when I look into this graph, I believe that this ratio do have a prediction power. uh, So for example, even you, if it's not 100% replicated, guys, the best what you can get, imagine that, okay, Shiller price earnings will be a little bit unusual, so it will be higher than the average. So at the moment, how much it is? It's 35. So that means that S&P 500 price divided by last 10 years average earnings stands at 35, right? While the medium and medium for the historical 20-year average they're talking about here is 26. So how do they actually calculate this implied return, right? Reasonable question. Uh, so basically what they do is that they assume that this ratio, Shiller price earnings, should always revert to the mean. A mean being 26, currently 35, right? So in 8 years, they expect that this will reverse to the mean. And even if now we can have a look if this doesn't happen, right? If this doesn't return to the mean and remains elevated for a longer period, there is this table on Guru website, very nice table. So they are talking about different scenarios. Let me just highlight it for you guys. So here I propose to look at these four, because really and truly, okay, you can get 7.5%, but you need to be really lucky. So that means that price earnings will increase further up. So even if earnings, so where your growth can come from when you invest in S&P or any other instrument, your growth can come from two different ways, being from expansion of the multiple, price earnings multiple, right? All things being equal. So imagine earnings don't change, but the price is rising. So the price earnings ratio is rising as well. So this is one of the sources you can get your return. Another source is increase in earnings of the underlying company, or a bunch of companies. So a bunch of companies. So in this, let's get back to this table. So basically, the best return. Let's forget about this one, because this is really and truly unlikely scenario, right? So we should not be looking into this. Let's look on these four items. The best outcome you can get is 5%, and look how much you can get from just investing in US government bonds, even 10 years, right? You will get 4.2 at much less risk. So that's the reason for me why I currently don't invest in S&P 500, and I recommend everyone to think twice before you go into it. Let me give you just one of the examples. So, for example, when we go back to US government bonds, right, there are a number of instruments which you can choose from. For example, this ETF, they invest in short-term treasury bills with maturity up to 3 months. And wait, let me just raise it, okay. And I will look at the yield. So currently it's 5%, very good yield, right? Even higher or at the same level if you go down, if you go back to this table, right? And you will need to be lucky here to achieve this 5%. Here it's like you don't even need to be lucky. You just need to hold it and much less risk. So I don't see any reasons why would. It's just an alternative ways for me at the moment to invest my hard-earned money. So now another reason which why I don't like S&P is, as you know, guys, recently there was an expansion of some stocks which are included in S&P index, for example, Nvidia, because of the crypto bubble, etc., etc. So let's have a look at the constituents of the S&P 500 ETF, which is SPY, right, which we looked on to before. If you look what kind of companies, right, largest companies which are represented in this index, have a look at these guys, have a look. This is very interesting. So at the moment, Nvidia, Microsoft, Apple, and Amazon as well, okay, these companies, these four companies. Or no, let's talk about let's talk about just these three companies. Okay, so the total of these three companies is 21% of their share in S&P index. Now you will question yourself, how well is your if you invest in S&P ETF, how well diversified will be your portfolio, because obviously you need to look into underlying, right? So 21%, just three stocks, guys, and they are all coming from technology sector. They are all coming from technology sector, which means you are sort of your concentration risk will be quite high here. Now, guys, I would like, so I already shared with you my views about some alternatives where you can go instead of S&P 500, for example. Now you can challenge me, obviously, and you can say, because my portfolio, I can tell you, my portfolio in this year just delivered slightly more than 2%, maybe 3%. And while S&P 500, I think, let's have a look together. How much they delivered? I think around 20% maybe year to date, right? Let's see together. So year to date return 11, 15. I think you need to look into this one. This one is monthly return. I think this will be the correct return. Okay, so 15%, guys, and I only delivered. Let me show you. On my eToro page, I only have around 3% year to date. So you can tell me, okay, but you missed that growth. You missed that increase in S&P 500, because obviously instead of investing in my own portfolio, I could have gone to S&P ETF. And it's correct. Yes, it's correct. It's correct. It's a reasonable question to ask. But still, guys, because in my portfolio, I mostly invest in dividend stocks, and I'm actually happy to have less return for some time. But I just don't want to join the crowd in this craziness. For me, it's craziness. All these ratios, guys, which are telling me that it will be 27. This is just crazy in my opinion. Okay, this is just crazy. I don't want to participate in this, because this is purely speculative return in my opinion. And I just want to give you some example of of more interesting opportunities. Again, in my view, for example, what I'm investing is I really like this ETF. So this is a high dividend, low volatility ETF, and look how wonderful this yield is here. This yield is 4%. And look at this price earnings comparing to S&P 500, which is 27. This one is just 17. So for me, it makes more sense. Yes, this ETF, so earnings which are underlying in this ETF, the earnings will not probably rise as fast as earnings of S&P constituents, but still I think that's even with this growth factored in, S&P is just too way expensive for me. So, okay, guys, this is my view. Feel free to share your views. Maybe I'm missing something when I look at this kind of analysis, which I shared with you today. Feel free to share your views, and I will be happy to discuss. And I hope to see you in the next video.